Hello everyone, welcome to Topical Economics. Today we are diving into the fascinating world of taxes and subsidies. Whether you are preparing for an exam or just looking to sharpen your economic knowledge, mastering multiple choice questions can be a game changer. In this video, we will explore effective strategies to identify the correct answers for questions related to taxes and subsidies from past papers. We will break down key concepts, analyze typical question formats, and share tips that will not only help you choose the right answers, but also deepen your understanding of how these economic tools impact our lives. So, grab your notes and let's get started. By the end of this video, you'll be equipped with the skills to tackle any multiple-choice question on taxes and subsidies with confidence. Let's jump right in. Starting with first question. The government puts a $2 tax on each $8 videotape sold. As a result, the price of a videotape rises from $8 to $8.50. What can be concluded from this? A. The demand for videotapes is price inelastic. B. The government will receive only 25% of its expected tax revenue. C. The incidence of the tax will fall mainly on the producer. D. The tax is progressive. The correct answer for this question is Option C. The incidence of the tax will fall mainly on the producer. The government imposed a $2 tax, but the price only rose by 50 cents, indicating that consumers did not bear the full tax burden. This suggests that the producer is absorbing most of the tax, implying that the incidence of the tax falls mainly on the producer. The demand for videotapes is likely elastic if the producers cannot pass the full tax onto consumers without significantly reducing sales. Let us analyze why the other options are not correct. Option A. The demand for videotapes is price inelastic. If the demand were price inelastic, most of the tax would be passed to the consumer, and the price would increase closer to the full $2. Option B. The government will receive only 25% of its expected tax revenue. This conclusion cannot be drawn from the information provided. The tax revenue would depend on the total number of videotapes sold, not just the price change. And Option D. The tax is progressive. This option is unrelated to the nature of the tax on videotapes. A progressive tax refers to a tax rate that increases as income increases, not to a tax on goods. Going to the second question. Which is a description of indirect taxes? A. They are easy to avoid and deter effort. B. They are levied on income and cause inflation. C. They are levied on spending and are regressive. D. They are progressive and discourage consumption. The correct answer for this question is Option C. They are levied on spending and are regressive. Indirect taxes are taxes imposed on goods and services rather than on income or profits. Common examples include sales tax, value-added tax, VAT, and excise duties. These taxes are often considered regressive because they take a larger percentage of income from lower-income individuals than from higher-income individuals, as everyone pays the same rate regardless of income. Let's look why the other options are not correct. Option A. They are easy to avoid and deter effort. Indirect taxes are not easy to avoid as they are applied directly at the point of sale or production. This description does not accurately characterize indirect taxes. Option B. They are levied on income and cause inflation. Indirect taxes are not levied on income, that would be a direct tax. While they can contribute to higher prices, linking them directly to causing inflation is an oversimplification. And Option D. They are progressive and discourage consumption. Indirect taxes are not generally progressive. Progressive taxes increase as the taxpayer's ability to pay increases, which is not the case with indirect taxes. Going to the third question. In a country, income tax is charged at $50 on an income of $500. Compared with this, which of the following would indicate that the income tax scale was progressive? A $150 tax on $2,000 income. B. $300 tax on $3,000 income. C. $450 tax on $4,000 income. D. $480 tax on $5,000 income. The correct answer for this question is Option C, $450 tax on $4,000 income. A progressive tax scale means that as income increases, the tax rate also increases. In the given example, the income tax on $500 is $50, which represents a tax rate of 10%, $50 divided by $500. If we calculate the tax rate for each option. For option A, $150 tax on $2,000 income, tax rate is 7.5%, $150 divided by $2,000. For option B, $300 tax on $3,000 income, tax rate is 10%, $300 divided by $3,000. For option C, $450 tax on $4,000 income, tax rate is 11.25%, $450 divided by $4,000. And, for option D, $480 tax on $5,000 income, tax rate is 9.6%, $480 divided by $5,000. We see that, since a progressive tax system requires the tax rate to increase as income rises, option C, 11.25%, is higher than the initial 10%, demonstrating that the tax scale is progressive. Moving to the fourth question. A government taxes the production of cars. What is likely to decrease? A. The cost of supplying cars. B. The price of cars. C. The revenue for the government. D. The supply of cars at every price. The correct answer for this question is option D. The supply of cars at every price. When a government imposes a tax on the production of cars, it increases the cost for producers. This added cost makes production more expensive, which typically results in a decrease in the supply of cars at every price level. The supply curve shifts to the left as producers are less willing to supply the same quantity at the previous prices due to the additional tax burden. Analyzing the other options. Option A, the cost of supplying cars, would actually increase, not decrease, because of the tax. Option B, the price of cars, is likely to increase, not decrease, as producers may pass some of the tax burden on to consumers. And, option C, the revenue for the government revenue from the tax would generally increase, not decrease, unless there is a drastic drop in production that offsets the expected tax revenue. Moving to the fifth question. A government wishes to make firms pay for the total cost of producing their goods, including external costs such as pollution. Which measure could the government use to do this? A. An increase in an indirect tax on the firm's goods. B. An increase in grants to the firm. C. An increase in subsidies for the firm's goods. D. Fixing a minimum price for the firm's goods. The correct answer for this question is option A. An increase in an indirect tax on the firm's goods. If a government wants firms to pay for the total cost of producing their goods, including external costs like pollution, it can impose an indirect tax on the goods. This tax internalizes the external costs by making firms responsible for paying for the negative externalities they create, such as environmental damage. This type of tax is often called a Pigovian tax, designed to correct for market inefficiencies caused by externalities. Analyzing the other options. Option B, an increase in grants to the firm, would have the opposite effect, as grants provide financial support, reducing the firm's costs rather than increasing them. Option C, an increase in subsidies for the firm's goods. Subsidies lower production costs for firms, encouraging more production and potentially increasing negative externalities. And, for option D, fixing a minimum price for the firm's goods, this measure would not directly address external costs, it would just set a price floor, which could have other economic impacts but wouldn't ensure firms cover the full social cost of production. Moving to the sixth question. A person pays $500 tax when earnings are $5,000. Which of the following tax payments would indicate that the country has a regressive tax system if his income rose to $12,000? A. $1,000. B. $1,200. C. $1,500. D. $2,400. The correct answer for this question is option A. $1,000. A regressive tax system is one where the tax rate decreases as the income of the taxpayer increases, meaning higher income earners pay a lower percentage of their income in taxes compared to lower income earners. In the initial scenario, the person pays $500 on $5,000 income, which is a tax rate of 10%, $500 divided by $5,000. For each of the options, we will calculate the tax rates for each option if the income rises to $12,000. For option A, $1,000, tax rate is approximately 8.33%, $1,000 divided by $12,000. For option B, $1,200, tax rate is 10%, $1,200 divided by $12,000. For option C, $1,500, tax rate is 12.5%, $1,500 divided by $12,000. And, for option D, $2,400, tax rate is 20%, $2,400 divided by $12,000. Since option A results in a lower tax rate, 8.33%, compared to the original 10% rate, it indicates a regressive tax system where the proportion of tax paid decreases as income increases. Moving to the 7th question. Which statement best explains why drought is an economic problem? A. Drought cannot be controlled. B. Rainfall is unreliable. C. The effects of drought involve the government. D. Water is a scarce good. The correct answer for this question is option D. Water is a scarce good. An economic problem arises when there are limited resources to meet unlimited wants and needs. Drought exacerbates this issue by reducing the availability of water, making it an even scarcer resource. This scarcity means that choices must be made about how to allocate water, leading to opportunity costs and other economic implications. On analyzing, the other options are not as strong. Option A, drought cannot be controlled. While true, this statement does not directly address why drought is an economic problem, it just states a fact. Option B, rainfall is unreliable, may contribute to the occurrence of droughts, but does not explain why droughts create economic problems. Option C, the effects of drought involve the government, is a consequence of drought but does not explain the underlying economic issue, which is the scarcity of water. And option D correctly identifies the fundamental economic problem of scarcity, which is why drought is a significant issue. Moving to the 8th question. Which will encourage domestic producers to grow more maize? A. Granting subsidies to maize producers. B. Increasing the sales tax on maize. C. Removing guaranteed minimum prices for maize. D. Removing quotas on imported maize. The correct answer for this question is option A. Granting subsidies to maize producers. Subsidies provided to maize producers lower their production costs, making it more profitable to produce maize. This incentive encourages domestic producers to increase their output to take advantage of the financial support. Analyzing the other options. Option B, increasing the sales tax on maize, would likely decrease demand for maize because it raises the price for consumers, which could discourage producers from growing more. Option C, removing guaranteed minimum prices for maize, would reduce the financial security that producers have, potentially leading to less production, not more. And option D, removing quotas on imported maize, would increase competition from foreign producers, which could discourage domestic producers from growing more maize due to the increased competition and potential lower prices. Subsidies directly support domestic producers by lowering their costs, thereby encouraging them to grow more maize. Moving to the 9th question. What is most likely to happen as unemployment falls? A. Economic growth falls. B. Inflation falls. C. Spending on welfare benefits rises. D. Tax revenue rises. The correct answer for this question is option D. Tax revenue rises. As unemployment falls, more people are employed, which typically leads to an increase in overall income and consumption. As a result, individuals contribute more in income taxes, and businesses may earn higher profits, contributing more in corporate taxes. Therefore, tax revenue for the government is likely to rise as unemployment decreases. Analyzing the other options. Option A. Economic growth falls. Generally, as unemployment falls, economic growth tends to rise because more people are working and contributing to the economy. For option B. Inflation falls. While the relationship between unemployment and inflation can vary, a decrease in unemployment can sometimes lead to upward pressure on wages and prices, potentially increasing inflation instead. And option C. Spending on welfare benefits rises. With lower unemployment, fewer individuals would be reliant on welfare benefits, which would likely lead to a decrease in spending on such programs. Overall, a decline in unemployment is usually associated with a rise in tax revenue. Moving to the 10th question. In September 2002, a government minister warned that tax changes were necessary to redistribute wealth from rich to poor. Which policy would be likely to achieve that aim? The correct answer for this question is option A. Reduced regressive tax will lead to higher tax revenue from those earning high, and keeping progressive tax at the same level will also lead to higher tax payment from the high earners. So, government will earn more tax to pay more unemployment benefits to the unemployed, and in this way income will be distributed from rich to the poor. Moving to the 11th question. The graph shows the percentage of tax taken from different levels of income by 4 different taxes. Which illustrates a regressive tax? The correct answer for this question is option D. In regressive tax system, tax rate falls with the rise in income. So, they are negatively related to each other, causing a negatively sloped curve. Moving to the 12th question. The diagram shows the demand for and the supply of bicycles. D1 and S1 are the original demand and supply curves, and X is the original equilibrium position. Which point shows the new equilibrium position after the granting of a subsidy to bicycle producers? The correct answer for this question is option D. Increase in cost of raw material decreases supply, and supply curve will shift to the left. On the other hand, successful advertising campaign will lead to increase in demand, and demand curve will shift to the right. In this way, new equilibrium will take place at D, where new demand and supply curves are intersecting each other. Moving to the 13th question. What is meant by the incidence of a tax? A. How the revenue raised by the tax is spent. B. How the tax is collected. C. Why the tax is imposed. D. Where the burden of the tax is finally felt. The correct answer for this question is option D. Where the burden of the tax is finally felt. The incidence of a tax refers to the distribution of the tax burden between buyers and sellers or consumers and producers. It indicates who ultimately bears the financial responsibility for paying the tax after market adjustments, regardless of who is initially charged. The tax burden may fall more on consumers, producers, or be shared between them, depending on the price elasticity of supply and demand. Analyzing the other options. Option A. How the revenue raised by the tax is spent refers to government expenditure, not tax incidence. Option B. How the tax is collected describes the tax collection process, but not the incidence of the tax. And option C. Why the tax is imposed relates to the purpose or reason for the tax, but not the incidence. Moving to the 14th question. The governments of many countries raise revenue from a tax on a wide range of essential goods and services. What is the nature of this tax? A. It is direct and proportional. B. It is direct and regressive. C. It is indirect and proportional. D. It is indirect and regressive. The correct answer for this question is option D. It is indirect and regressive. Taxes on essential goods and services, such as sales tax or value-added tax, VAT, are indirect taxes because they are imposed on transactions rather than directly on income or wealth. These taxes are often considered regressive because they take a larger percentage of income from lower-income individuals than from higher-income individuals. This is because everyone pays the same rate, but lower-income individuals spend a greater proportion of their income on essential goods. Analyzing the other options. Option A. It is direct and proportional, refers to taxes that are levied directly on income, like income tax, and proportional means the rate stays the same across income levels. This does not describe taxes on goods and services. Option B. It is direct and regressive. Direct taxes are levied on income or wealth, not on consumption. Essential goods taxes are indirect. And option C, it is indirect and proportional. While these taxes are indirect, they are not proportional. A proportional tax implies a constant rate across all income levels without disproportionately affecting lower income earners. Moving to 15th question. Why might a country's central bank raise its interest rate? A. To encourage saving. B. To increase the money supply. C. To raise funds for the government. D. To reduce the level of employment. The correct answer for this question is option A. To encourage saving. A country's central bank may raise its interest rate to encourage saving and reduce inflationary pressures. Higher interest rates make saving more attractive because individuals and businesses can earn more on their deposits. Additionally, higher rates typically lead to reduced borrowing and spending, which can help slow down an overheating economy and control inflation. Moving to the 16th question. What is most likely to happen if a regressive tax replaces a progressive tax? A. The amount of tax paid by richer people increases. B. Incomes before tax become less equal. C. The majority of people continue to pay the same tax. D. The amount of tax paid by poorer people increases. The correct answer for this question is option D. The amount of tax paid by poorer people increases. If a regressive tax replaces a progressive tax, the burden of taxation shifts more heavily onto lower-income individuals. Regressive taxes take a larger percentage of income from lower-income earners than from higher-income earners, whereas progressive taxes take a higher percentage from higher-income earners. As a result, poorer individuals would end up paying a relatively higher share of their income in taxes compared to richer individuals. Analyzing the other options. Option A, the amount of tax paid by richer people increases, is not true. In fact, the opposite is likely to happen. Under a regressive tax system, richer people would pay a smaller proportion of their income in taxes. Option B, incomes before tax become less equal. The tax system affects disposable income after taxes, not incomes before taxes. However, regressive taxes can increase income inequality after taxes. Lastly, option C, the majority of people continue to pay the same tax, is unlikely, as the shift from a progressive to a regressive tax structure would change the distribution of the tax burden. Moving to the 17th question. A government decides to reduce income tax. Which aims of government policy would this help to achieve? A. A smaller balance of payments deficit and lower inflation. B. A smaller balance of payments deficit and more economic growth. C. Lower unemployment and lower inflation. D. Lower unemployment and more economic growth. The correct answer for this question is option D. Lower unemployment and more economic growth. Reducing income tax puts more disposable income in the hands of consumers, which can lead to increased consumer spending. This rise in consumption stimulates economic growth as businesses experience higher demand for their goods and services. To meet this increased demand, businesses may expand production, leading to more job creation and, therefore, lower unemployment. Analyzing the other options. Option A, a smaller balance of payments deficit and lower inflation. Reducing income tax may actually worsen the balance of payments deficit because increased spending can lead to higher imports. Additionally, higher consumption can put upward pressure on prices, potentially increasing inflation, not lowering it. Options B, a smaller balance of payments deficit and more economic growth. While economic growth may occur, the balance of payments deficit might not improve for the reasons mentioned above. Lastly, option C, lower unemployment and lower inflation. While reducing unemployment is likely, inflation could rise due to increased demand, not fall. Moving to the 18th question. What is likely if the proportion of retired people in a country increases? A. A reduction in income from direct taxation. B. A reduction in the dependency ratio. C. An increase in the total number of jobs available. D. A reduction in spending on medical treatment. The correct answer for this question is option A. A reduction in income from direct taxation. If the proportion of retired people in a country increases, it is likely to lead to a reduction in income from direct taxation. This is because retired individuals generally have lower incomes than those who are employed and may rely more on pensions or savings, which might not be subject to the same level of income tax as wages. Analyzing the other options. Option B says a reduction in the dependency ratio. An increase in the proportion of retired people would actually increase the dependency ratio, as more individuals are dependent on the working-age population. Lastly, option C says an increase in the total number of jobs available. An increase in the number of retired people does not directly lead to more job creation. It may result in a need for more jobs in specific sectors like healthcare, but not an overall increase in total jobs. Moving to the 19th question. What would cause disposables income to become less equal? A. Increased employment. B. Increased welfare benefit. C. More progressive tax. D. More regressive tax. The correct answer for this question is option D. More regressive tax. A regressive tax takes a larger percentage of income from lower income earners than from higher income earners. Implementing or increasing regressive taxes can make disposable income distribution less equal, because lower-income individuals end up with a proportionally larger tax burden. This increases income inequality as higher-income earners retain a greater share of their income compared to lower-income earners. Analyzing the other options. Option A. Increased employment. Generally, increased employment can lead to more people earning wages and reducing income inequality as more individuals have income. Option B. Increased welfare benefit would help to make disposable income more equal, as welfare benefits provide financial support to lower-income individuals. And option C. More progressive tax. A progressive tax system takes a larger percentage from higher-income earners and helps reduce income inequality by redistributing income. Moving to question number 20. The diagram relates the government's total tax revenue to the average tax rate. What can be deduced from the diagram? A. A rise in the average tax rate may decrease government revenue. B. The tax system is regressive. C. Low tax rates have an incentive effect upon labor. D. The burden of taxation is evenly spread. The correct answer for this question is option A. A rise in the average tax may decrease government revenue because when tax rate becomes high, many people would try to evade it. Moving to question number 21. What is meant by a regressive indirect tax? A. A tax on income that falls more heavily on the poor. B. A tax on income that falls more heavily on the rich. C. A tax on spending that falls more heavily on the poor. D. A tax on spending that falls more heavily on the rich. The correct answer for this question is option C. A tax on spending that falls more heavily on the poor. A regressive indirect tax is a tax on spending or consumption, such as sales tax or value-added tax, that takes a larger proportion of income from lower-income earners than from higher-income earners. While everyone pays the same tax rate on goods and services, it disproportionately impacts poorer individuals because they spend a larger share of their income on taxed essentials compared to wealthier individuals. Analyzing the other options. Option A. A tax on income that falls more heavily on the poor, describes a regressive direct tax, not an indirect tax. Option B. A tax on income that falls more heavily on the rich, describes a progressive tax, not a regressive one. Lastly, option D. A tax on spending that falls more heavily on the rich, does not describe a regressive tax. Regressive taxes affect poorer individuals more. Moving to question number 22. Rose earns $12,000 per annum and pays $4,000 per annum in income tax. Johan earns $20,000 per annum and pays $5,000 per annum in income tax. What describes this system of income tax? A. Flat rate. B. Progressive. C. Proportional. D. Regressive. Given the details provided about Rose and Johan. Rose's tax rate, $4,000 tax on $12,000 income equals 33.33%. Johan's tax rate, $5,000 tax on $20,000 income equals 25%. In this scenario, we see that Rose pays a higher percentage, 33.33%, of her income in taxes compared to Johann, who pays a lower percentage, 25%, of his income. This means that as income increases, the percentage of income paid in tax decreases. So, the correct answer for this question is option D, regressive, because lower income individuals, like Rose, are paying a higher effective tax rate than higher income individuals, like Johann. Moving to question 23. In 2003 in the UK, income tax raised $110 billion at a cost of 1.4p per $1 raised. Company tax raised $21.1 billion at a cost of 1.2p per $1 raised. What can be concluded from comparing this information on the two taxes? A. Company tax was the more productive tax. B. Company tax caused less tax avoidance. C. Income tax was the more progressive tax. D. Income tax was less economical to collect. The correct answer for this question is option D. Income tax was less economical to collect. To analyze the efficiency of the two taxes in terms of collection costs, we can look at the cost per dollar raised. For income tax, the amount raised is $110 billion and cost is 1.4 pence per dollar raised. For company tax, the amount raised is $21.1 billion and cost 1.2 pence per dollar raised. Now, let's convert the costs to a common format for easier comparison. Since 1 pence is 1/100 of a pound, we can express the costs in terms of dollars. Income tax cost per dollar cost equals 1.4 pence equals $0.014. And company tax cost per dollar cost equals 1.2 pence equals $0.012. So we see that for every dollar raised, income tax costs $0.014 to collect, while company tax costs $0.012. This means that it is less economical to collect income tax compared to company tax, as it costs more per dollar raised. Looking at the other options. Option A, company tax was the more productive tax. While company tax has a lower collection cost per dollar, it raises significantly less revenue than income tax. Thus, calling it more productive isn't accurate in the context of total revenue raised. Option B, company tax caused less tax avoidance. This information does not provide any insight into tax avoidance behavior related to either tax. Lastly, option C, income tax was the more progressive tax. The progressive nature of the tax system is not addressed in the provided information. The question is focused on collection efficiency, not the progressivity of the taxes. Moving to question 24. A country has different rates of income tax, depending on the level of income earned. The highest rate of income tax is cut from 40% to 38%. From this statement, it can be deduced that taxation will become A. Less indirect. B. Less progressive. C. Less regressive. D. More difficult to evade. The correct answer for this question is option B. Less progressive. When the highest rate of income tax is cut from 40% to 38%, it indicates a decrease in the tax burden on higher income earners relative to lower income earners. This change means that the tax system becomes less progressive because a progressive tax system is characterized by higher tax rates on higher incomes. Analyzing the other options. Option A, less indirect, doesn't change the nature of indirect versus direct taxation, it only discusses income tax rates. Option C, less regressive, does not suggest a change that would make the tax system less regressive. Instead, it pertains to the income tax structure. Lastly, option D, more difficult to evade, the change in tax rates does not imply any change in the ease or difficulty of tax evasion. Moving on to question 25. The government pays a subsidy for each worker employed by a firm in an area of high unemployment. When would this policy be most successful in reducing unemployment? A. When the firm is capital intensive. B. When the firm is labor intensive, requiring mainly unskilled labor. C. When the firm provides professional services. D. When the firm requires mainly specialist, skilled labor. The correct answer for this question is Option B, when the firm is labor-intensive, requiring mainly unskilled labor. A subsidy for each worker employed is most effective in reducing unemployment when applied to firms that are labor-intensive and require mainly unskilled labor. Here's why. Labor-intensive firms rely heavily on a large number of workers rather than machines or technology. By providing subsidies, the government incentivizes these firms to hire more employees, thereby directly increasing job opportunities in areas of high unemployment. Next, unskilled labor. If the labor required is primarily unskilled, the barrier to entry for employment is lower. This means that more people in the community, including those who may be long-term unemployed, can find work, further reducing the unemployment rate. Analyzing the other options. Option A, when the firm is capital-intensive. Capital-intensive firms use more machinery and technology than labor, so subsidies for workers would have a limited impact on overall employment levels. Option C, when the firm provides professional services. These typically require higher education and skills, which may not be accessible to the unemployed in high unemployment areas, limiting the effectiveness of the subsidy. Lastly, option D, when the firm requires mainly specialist, skilled labor, similar to professional services. This would limit employment opportunities for unskilled or less skilled workers, making it less effective in reducing unemployment. Moving to question 26. What is the main reason why indirect tax is thought to be unfair? A. Not everyone pays an indirect tax. B. The consumer is unaware of the rate of tax. C. The retailer is forced to collect the tax of the government. D. The tax burden is greater for people on low income. The correct answer for this question is option D. The tax burden is greater for people on low income. Indirect taxes, such as sales tax or value-added tax, VAT, are often considered unfair because they take a larger percentage of income from lower-income individuals compared to higher-income individuals. This is due to the following reason: that it is regressive in nature. Indirect taxes are generally regressive. Everyone pays the same rate on goods and services, which means that poorer individuals spend a higher proportion of their income on these taxes. For example, if a low-income person spends all of their income on basic necessities, they may end up paying a significant portion of their income in indirect taxes. Analyzing the other options. Option A, not everyone pays an indirect tax. While it's true that some individuals may not purchase goods subject to indirect taxes, the unfairness mainly stems from the burden relative to income levels. Option B, the consumer is unaware of the rate of tax. While this may contribute to confusion, it is not the main reason for the perceived unfairness of the tax system. Lastly, option C, the retailer is forced to collect the tax of the government, does not address the fairness of the tax burden on consumers. It's more about the administrative aspect of tax collection. Moving on to question 27. What is a direct tax? A. A tax on electricity. B. A tax on imported goods. C. A tax on services. D. A tax on income and wealth. The correct answer for this question is option D. A tax on income and wealth. Direct taxes are taxes that are levied directly on an individual's or entity's income, wealth, or profit. They are paid directly to the government by the taxpayer. Common examples of direct taxes include income tax, corporate tax, and property tax. Analyzing the other. Option A, a tax on electricity, is typically an indirect tax, as it is levied on consumption rather than directly on income or wealth. Option B, a tax on imported goods, is also an indirect tax, known as a tariff or customs duty, which is paid when goods are imported. Lastly, option C, a tax on services, usually refers to value-added tax, VAT, or service tax, which are indirect taxes applied to the sale of services. Moving to question 28. The diagram shows that when a tax of $2 on a good raises the supply curve from S1 to S2, the price to the consumer rises from $4 to $5. What is the total tax yield to the government? A. $75. B. $150. C. $200. D. $375. Total tax yield equals tax amount per unit times quantity sold. When price rises from $4 to $5, the quantity is Q equals 75. So, the total tax yield equals 2 times 75 is equal to $150. So the correct answer for this question is option B. Moving to question 29. Direct taxes can be used to A. Place the burden of tax on sellers, not buyers. B. Protect domestic industries from foreign competition. C. Raise revenue without affecting the number of hours employees work. D. Redistribute incomes from rich to poor. The correct answer for this question is option D. Redistribute incomes from rich to poor. Direct taxes, such as income tax and wealth tax, can be structured in a way that places a higher tax burden on higher income earners compared to lower income earners. This progressive nature of direct taxes helps to redistribute wealth within the economy, contributing to social equity and reducing income inequality. Analyzing the other options. Option A. Place the burden of tax on sellers, not buyers, more accurately describes indirect taxes, where the seller collects the tax from the buyer. Option B. Protect domestic industries from foreign competition. While tariffs, an indirect tax, can protect domestic industries, direct taxes do not serve this purpose. Lastly, option C. Raise revenue without affecting the number of hours employees work. While direct taxes can raise revenue, they can influence individuals' decisions about work, such as how many hours to work or whether to work at all, particularly if they are high. Proceeding with question 30. Brazil is a highly taxed economy. Some Brazilian economists have suggested that if the government were to cut tax rates, the government would actually receive more tax revenue. Why may cutting taxes increase revenue? A. It may encourage emigration. B. It may increase the tax burden. C. It may lead to a fall in investment. D. It may reduce tax evasion. The correct answer for this question is option D. It may reduce tax evasion. Cutting tax rates can sometimes lead to an increase in overall tax revenue for several reasons, one of which is that lower tax rates may encourage compliance and reduce tax evasion. When tax rates are perceived as excessively high, individuals and businesses may seek ways to evade taxes, either through illegal means or by moving their income to lower tax jurisdictions. By reducing tax rates, the government can create a more favorable environment that encourages individuals and businesses to report their income honestly and pay taxes, thereby increasing overall tax revenue. Analyzing the other options. Option A. It may encourage emigration. While high taxes can sometimes lead to emigration, cutting tax rates would generally be more likely to encourage people to stay and invest rather than leave. Option B. It may increase the tax burden. This statement is unclear. Cutting tax rates typically decreases the tax burden, not increases it. If anything, the goal is to increase tax compliance and revenue rather than increase burdens. Lastly, option C. It may lead to a fall in investment. Generally, cutting tax rates is expected to stimulate investment rather than reduce it, as businesses are more likely to invest when they have more capital available. Proceeding with question 31. In a country where the demand for petrol, gas, is price inelastic, the incidence of any increase in petrol tax will be mainly on A. The company that refines the oil. B. The motorist who buys the petrol. C. The petrol station that sells the petrol. D. The wholesale company that stores the petrol. The correct answer for this question is option B. The motorist who buys the petrol. When the demand for a good, such as petrol, is price inelastic, it means that consumers are not very responsive to changes in price. In this case, if the government increases the tax on petrol, the price will likely rise, but consumers will still buy relatively the same amount because they need it and have few alternatives. As a result, the burden of the tax, or the incidence of the tax, falls mainly on the consumers, motorists, who purchase the petrol. They are less likely to reduce their consumption significantly in response to the price increase, meaning they will bear most of the tax burden. Analyzing the other options. Option A. The company that refines the oil. While refiners may feel some impact, the inelastic demand indicates that consumers will bear the tax burden more than producers. For option C, the petrol station that sells the petrol. Similar to refiners, petrol stations may experience some effects, but the final incidence will be on the consumers. Lastly, option D, the wholesale company that stores the petrol. Wholesale companies also won't bear as much of the tax burden because the increased costs will primarily be passed on to the consumers. Proceeding with question 32. When is a direct tax is described as progressive? A. When the government changes the basic rate of tax in each budget. B. When the government tax companies rather than individual. C. When a tax takes a larger proportion of earnings as earning increases. D. When the tax takes a smaller proportion of earning as earning increase. The correct answer for this question is option C. When a tax takes a larger proportion of earnings as earnings increase. A progressive tax system is one in which the tax rate increases as the taxable income increases. This means that individuals with higher incomes pay a larger percentage of their income in taxes, compared to those with lower incomes. The intent behind progressive taxation is to reduce income inequality by ensuring that those who have a greater ability to pay contribute a larger share of their income to support public services and government functions. Analyzing the other options. Option A, when the government changes the basic rate of tax in each budget. Changing tax rates does not inherently indicate whether a tax is progressive or not. It's more about how the tax rates relate to income levels. Next, option B, when the government taxes companies rather than individuals, refers to corporate taxes, which are a separate issue and do not define the progressiveness of a tax system. Lastly, option D, when the tax takes a smaller proportion of earnings as earnings increase, describes a regressive tax system, where higher earners pay a smaller percentage of their income in taxes. Moving on to question 33. In 2008, the government of Argentina imposed a tax on exports of wheat and soya beans. What was the most likely aim of this tax? A. To increase agricultural output. B. To increase exports. C. To reduce a budget surplus. D. To reduce the rise in domestic food prices. The correct answer for this question is option D, to reduce the rise in domestic food prices. By imposing a tax on exports of wheat and soya beans, the Argentine government likely aimed to keep more of these staple products within the country to stabilize or reduce domestic food prices. When export taxes are implemented, it makes it less profitable for producers to sell their goods overseas, which can lead to an increase in the domestic supply of those goods. This action is typically taken to mitigate rising food prices, particularly in times of inflation or when there are concerns about food security. Analyzing the other options. Option A, to increase agricultural output. Export taxes typically do not directly lead to an increase in agricultural output. Instead, they aim to manage market dynamics and prices. Option B, to increase exports, is contradictory. Imposing a tax on exports usually discourages exports, not encourages them. Lastly, option C, to reduce a budget surplus. The purpose of the tax is more related to controlling domestic prices rather than addressing budget surpluses. Moving on to question 34. Which statement is mostly likely to be correct? A. A direct tax benefits the government. B. An indirect tax benefits the small shopkeepers. C. A progressive tax benefits successful entrepreneur. D. A regressive tax benefits lower income earner. The correct answer for this question is option A. A direct tax benefits the government. Direct taxes, such as income tax or corporate tax, are imposed directly on individuals or organizations, and the revenue generated from these taxes goes directly to the government. This revenue is crucial for funding public services, infrastructure, and various government initiatives. Therefore, the statement that a direct tax benefits the government is accurate. Analyzing the other options. Option B. An indirect tax benefits the small shopkeepers. While small shopkeepers may collect indirect taxes, like sales tax, from customers, the overall burden of indirect taxes can be challenging for consumers, especially those with lower incomes. Thus, it doesn't necessarily benefit them as a group. Option C. A progressive tax benefits successful entrepreneurs. Progressive taxes are designed to tax higher incomes at higher rates, which may not necessarily benefit entrepreneurs, particularly if they are successful and earning substantial income, as they would pay more in taxes. Lastly, option D, a regressive tax benefits lower income earners. Regressive taxes take a larger percentage of income from low-income earners compared to high-income earners, making this statement incorrect. Such taxes can disproportionately affect those with lower incomes. Moving on to question 35. Which government policy would be likely to help local companies expand? A. Encouraging investment by foreign companies. B. Increasing income tax. C. Providing a subsidy. D. Raising interest rates. The correct answer for this question is option C, providing a subsidy. Providing a subsidy to local companies can help them reduce their production costs, making it easier for them to expand their operations. Subsidies can enable businesses to invest in new technology, hire additional staff, or increase production capacity. This support can stimulate growth and expansion in local firms, particularly in competitive markets. Analyzing the other options. Option A, encouraging investment by foreign companies. While attracting foreign investment can have positive effects on the economy, it does not directly help local companies expand. It might even increase competition for local firms. Next, option B, increasing income tax. Higher income taxes can reduce disposable income for consumers and potentially decrease spending, which can negatively impact local businesses rather than support their expansion. Lastly, option D, raising interest rates. Higher interest rates typically make borrowing more expensive, which can deter companies from taking loans for expansion. This policy would likely hinder rather than help local companies. Moving on to question 36. Which type of tax is a sales tax, VAT? A. Direct tax. B. An indirect tax. C. A progressive tax. D. A proportional tax. The correct answer for this question is option B, an indirect tax. A sales tax, including value-added tax, VAT, is considered an indirect tax because it is levied on goods and services rather than directly on income or profits. Indirect taxes are typically collected by retailers at the point of sale and then passed on to the government. Consumers ultimately bear the burden of these taxes, but they are not directly deducted from their income. Analyzing the other options. Option A, a direct tax. Direct taxes are imposed directly on individuals or organizations, such as income tax or property tax. Option C, a progressive tax, is one that takes a larger percentage of income from higher income earners, which does not apply to sales taxes. Lastly, option D, a proportional tax, takes the same percentage from all income levels, which also does not characterize a sales tax, as it applies to consumption rather than income. Moving on to question 37. A tax on which of the following is usually progressive and is paid by a large number of tax payers? A. Company profits. B. Goods and services. C. Incomes. D. Sales of shares. The correct answer for this question is option C, incomes. Income tax is generally considered a progressive tax, meaning that individuals with higher incomes pay a higher percentage of their income in taxes compared to those with lower incomes. This system aims to reduce income inequality by ensuring that those who can afford to contribute more do so. Analyzing the other options. Option A, company profits. While corporate tax can be considered progressive in relation to different company sizes, it is not directly paid by individual taxpayers in the same way income tax is. Option B, goods and services. Taxes on goods and services, such as sales tax or VAT, are typically regressive, meaning they take a larger percentage of income from lower income individuals compared to higher income individuals. And option D, sales of shares. Taxes on capital gains from the sale of shares can vary in progressiveness depending on the country's tax laws, but are not universally categorized as progressive like income tax. Moving on to question 38. A country has a tax system which places no tax on incomes below $5,000, is proportional on incomes between $5,000 and $10,000, and is progressive on incomes above $10,000. Which graph illustrates this tax system? The correct answer for this question is option A. To illustrate the tax system described in the question, the diagram should have no tax on incomes below $5,000. This means that for any income level from $0 to $5,000, the tax rate is 0%. On a graph, this would be a flat line at the zero tax rate up to the income of $5,000. Next, it should have proportional tax on incomes between $5,000 and $10,000. This means that for incomes in this range, a constant percentage is applied. The tax line would start at the point where the income is $5,000 and rise at a steady slope until it reaches $10,000. Lastly, progressive tax on incomes above $10,000. This means that for any income above $10,000, the tax rate increases as income increases. On the graph, this would be represented as a line that starts at the tax amount calculated for $10,000 and rises at an increasing rate, steeper slope, for higher incomes. All this is very clearly depicted in option A diagram. Moving to question 39. A country has a proportional system of taxation. A person pays $500 tax when earning $5,000. How much tax will be paid if earnings rise to $12,000? A $120. B $500. C $1,200. D $7,500. To determine the tax paid under a proportional system of taxation, we first need to calculate the tax rate based on the information provided. To calculate the tax rate, we see that tax paid at $5,000 income, $500. So, the tax rate equals tax paid divided by income equals $500 divided by $5,000 equals 0.1 or 10%. Next, to calculate the tax for $12,000 income. Tax at $12,000 equals 10% of $12,000 equals 0.10 times $12,000 equals $1,200. Therefore, the correct answer for this question is option C, $1,200. Moving on to question 40. Goods and Services Tax, GST, is charged on purchases at 15% in New Zealand and 10% in Australia. This tax is considered to be A. Direct, B. Progressive, C. Proportional, D. Regressive. The correct answer for this question is option D, regressive. Goods and Services Tax, GST, is typically considered a regressive tax because it takes a larger percentage of income from lower-income individuals than from higher-income individuals. This is because everyone pays the same tax rate on purchases, regardless of their income level. Consequently, lower-income individuals spend a larger proportion of their income on goods and services subject to GST, making the tax burden heavier on them relative to their income compared to wealthier individuals. Let us analyze the other options as well. Option A, direct. Direct taxes are imposed directly on individuals' income or wealth, e.g., income tax, not on consumption. Option B, progressive. Progressive taxes take a larger percentage from higher incomes, which is not the case with GST. Lastly, option C, proportional. Proportional taxes take the same percentage from all income levels, but GST is not typically categorized this way as it applies to spending rather than income. Moving on to question 41. The graph shows the impact of a tax on the supply of petrol, gas. What can be concluded from this graph? A. The government will receive no tax revenue. B. The impact of the tax will be shared between the consumer and the producer. C. The impact of the tax will fall entirely upon the consumer. D. The impact of the tax will fall entirely on the producer. The correct answer for this question is option C. The impact of the tax will fall entirely upon the consumer because the demand is perfectly inelastic and consumers will have to buy the good in each case. So producers can easily shift the tax burden upon consumers. Moving to question 42. A government wants to reduce basic food prices without making the current account of the balance of payments worse. What should it do? A. Ban food exports. B. Put duties on food imports. C. Ration basic food. D. Subsidize local food producer. To reduce basic food prices without negatively impacting the current account of the balance of payments, the government should, option D, subsidize local food producers. Subsidizing local food producers would lower their production costs, allowing them to sell food at lower prices. This can lead to a reduction in basic food prices in the domestic market without affecting the import or export levels, thus not worsening the current account. Analyzing the other options. Option A, ban food exports. While this may lower domestic food prices, it could harm local farmers and the economy, and it may also negatively impact the current account by removing potential revenue from exports. Next, option B, put duties on food imports, would likely increase the prices of imported food, which could exacerbate food price inflation rather than reduce it. Additionally, it could lead to trade disputes and affect relationships with trading partners. Lastly, option C, ration basic food. Rationing may control prices temporarily, but it could lead to shortages and does not address the underlying production issues. It would also likely create black markets and dissatisfaction among consumers. Proceeding to question 43. In an economic recession, which policy might be adopted to reduce unemployment? A, an increase in foreign exchange rate. B, an increase in interest rates. C, a reduction in import duty. D, a reduction in tax rate. In an economic recession, the policy that might be adopted to reduce unemployment is option D, a reduction in tax rate. A reduction in tax rates can stimulate economic activity by increasing consumers' disposable income, encouraging spending and investment. This, in turn, can lead to job creation and a reduction in unemployment as businesses respond to increased demand for their products and services. Let us analyze other options as well. Option A, an increase in foreign exchange rate. Sad face appreciation of the domestic currency could make exports more expensive and imports cheaper, potentially harming domestic industries and leading to higher unemployment. Next, option B, an increase in interest rates, typically discourage borrowing and spending, which can further slow down economic activity and increase unemployment during a recession. Lastly, option C, a reduction in import duty. While this could lower prices for imported goods, it may not directly stimulate domestic production or job creation, and it could harm local industries that compete with imports. Moving to question number 44. 48, which will encourage domestic producers to grow more maize. A, granting subsidies to maize producers. B, increasing the sales tax on maize. C, removing guaranteed minimum prices for maize. D, removing quotas on imported maize. The correct answer for this question is option A, granting subsidies to maize producers. Granting subsidies to maize producers lowers their production costs and increases their profitability, providing an incentive to grow more maize. Subsidies can help farmers cover expenses and enhance their ability to invest in their operations, leading to increased production. Analyzing the other options. Option B, increasing the sales tax on maize, would raise the cost for consumers and could lead to reduced demand for maize, discouraging production. Next, option C, removing guaranteed minimum prices for maize, would expose producers to greater market risks and potentially lower their income, which could discourage them from growing maize. Lastly, option D, removing quotas on imported maize, could lead to an influx of cheaper imported maize, increasing competition for domestic producers and potentially reducing their output as they struggle to compete on price. Thank you so much for watching this video on topical economics. I hope you found these strategies for tackling multiple choice questions on taxes and subsidies helpful and insightful. If you enjoyed this content, please give it a thumbs up, and don't forget to subscribe to our channel for more economics tips and tricks. Your support means the world to me, and it helps us continue creating valuable content for learners like you. If you have any questions or topics you would like us to cover in future videos, feel free to leave a comment below. I would love to hear your thoughts.